Hey guys, what's going on? Welcome back. So in this video, I'm going to be going over how do I pick my individual dividend paying stocks, and then what are the situations that I like to look for with these companies, and then, what's my checklist that I run through as to really opens the door for should I invest in this company or should I not invest in this company? And then I'm going to go over my little quick checklist in terms of like, okay, what does everything need to be checked off before I even decide to do the deep dive into a company, make sure I'm not wasting my time, and make sure that my capital isn't going to be in a very risky asset. So I'm just going to be kind of doing that at a high level. But before I do that, I just kind of want to show this portfolio right here. I just kind of slapped this together on M1 Finance with most of the dividend paying stocks that I personally have been following for a long period of time. I don't own a position in all these companies. This was just kind of I was going off of my head, like of all the companies I look at right now, if I was looking for a income related investment, where would I park it? And these were all the companies that came to my mind that I remember looking into and either started a position in or didn't start a position in just because the timing wasn't right or because it didn't fit in my portfolio properly. But if I was just purely looking for a dividend play to add to my portfolio to supplement it, these are the companies that I would first go to. All right, but enough of that. You guys want me to get right into the video, so I will stop talking and do that. And as always, guys, make sure to smash that like button, hit the subscribe button, and throw a comment in the comment section down below if you guys want more of this type of content in the future. It will really help me kind of tailor these videos to you, my consumers. So, it would really mean a lot to me. But I'll shut up now and let's jump into the video. All right, so starting things off, let's talk about the two types of situations I personally look for when I'm going to be putting my money into a dividend-paying company. And that is, I look for two key characteristics. I either look for a dividend growth company, or I look for a dividend-paying company that is at such a steep discount, I think the risk-reward is skewed so much in my favor, I just need to buy it. And so I'm going to be going through those two things, then going through my little checklist of, okay, these are the kind of companies I'm looking at. Let me go through these fundamentals real quick and see if it's even worth me doing that deep dive. So I'll get into that in just a bit. But starting things off, looking for, let's say, growth companies at first, or dividend growth stocks. We'll call it that. That's what most people call them. And that's going to be focused around companies that I think are still growing. They're relatively robust, but they still have years ahead of them in terms of growth, in my opinion. And they are riding a secular trend. Now, a secular trend is a trend that isn't going to be going away anytime soon. It's a trend that's here to stay. And it's a trend that, in my opinion, I could feel comfortable, saying this is still going to be popular 10 years from now. And only a couple of things fit into that niche, so there aren't many companies in this category that I would be picking. But the ones that I do, I am pretty confident in, letting my money ride out through thick or thin with how these companies perform, especially in the short term. Now, taking a look at these types of stocks, I want to first approach them from a consumer standpoint. So I don't immediately go to a screener or anything like that because, just depending on 1 year or 1 quarter of like wonky accounting measures, any type of company could get included or not included in a screen that should or shouldn't be there. So I don't really like doing that to start off with. I like doing it after I already have my watch list, just trying to keep tabs on them and see how they're performing. But I don't like initially going in with a screener because I think you're missing too much. What I first like to do is take that holistic approach and really see, okay, as a consumer, what do I think I'm going to spend money in for the next 10 years? And what do I think everybody else that I know is going to be putting their money into for the next 10 years? The best way to do this, in my opinion, is, kind of taking a note directly from Peter Lynch, and that is to go to the mall. You go to the mall in a relatively higher income area, and you walk down and you see what stores are booming all the time. So, in my opinion, you can kind of look at an Apple store. You can look at a Microsoft store. You can look at a Starbucks or anything like that. Any of those mega, trendy cult following type of establishments. Those are generally the companies that have a very well-established customer base. And they are the ones that customers will continuously spend their time, their money, and, anything else that they can do relating to this company, they generally do. Whether they're bored and they just buy a cup of coffee and chill out of Starbucks for 3 hours and then maybe buy another one when they're there. Whether they are, trying to show off to their friends and they rush to the Apple store to buy out the new iMac Pro. There's all these types of things that you can kind of clearly show from the consumer standpoint. In my opinion, the consumer is always going to drive a business over the long run. You can very blatantly tell what stores have that cult following or that moat around them versus ones that are just kind of popping up and they're kind of trendy but some people are going once or twice and there's a lot of hype around it, but then they're not being a return customer. And I'm not interested in that. I'm interested in secular trends, not short-term trends. Now, another cool way to look at a good company is, especially if you're in college, when you go out on Friday nights and you're hitting up the bars, make sure you pay attention to what, beer on the tab is getting, just utterly destroyed by the frat boys sitting in the corner. Because generally, that beer or whatever alcohol it is going to have a massive amount of growth. So you can kind of look at it, like say when Bud Light started to get revamped, when Post Malone got on board with it. Smirnoff, Natty Ice, everything like that. Like those were very cult-like following alcoholic beverages that, especially young adults really gravitated towards. And their company's sales did really well based off that. And I don't think those brands are going anywhere. So that's just another tidbit. There's always, regardless of the situation, if there are other people, you can find a good investment idea. And now investing in this type of dividend growth company, I think that one, it needs to have that secular trend, and two, it obviously needs to be paying a growing dividend. And I think that if the dividend is growing, if the company is relatively refined, but the consumer cult following is there, that's the biggest point, in my opinion, for where I should be parking my money for 10 years. If that's there, I expect that company to outperform the overall stock market, at least by a little bit, over the long term. And now I'm not expecting any of these companies to, become massive 20 baggers in just a couple of years. I expect them to average between 9 and say 12% returns, adding a little bit of volatility, a little bit more risk than the overall broad market. But between the growing dividend and just the growing consumer sentiment around the company, I think they're going to be one of the better companies to park your money in the overall market. So these are companies that are relatively refined, but they still have a lot of growth ahead of them, in my opinion. Now, the next group of dividend stocks I want to talk about are deep value. Now, the next type of dividend stocks I want to talk about are deep discount or deep value types of companies. Now, these are companies that that I have looked at and that are notorious for paying a solid dividend year after year for decades at a time. They've always grown their dividend. They've never, say, randomly cut their dividend. They've never had a massive shock to their overall business model. And, for time and time again, investors in past and probably in the future have counted on these companies for a steady return of cash flow. And for some reason, something in the market, whether it's fundamental or not, the entire market becomes extremely pessimistic on these companies. So you can think of like a Coca-Cola back in the 80s. You can think of an Altria currently. You can think of an AbbVie currently. You can think of, a Johnson & Johnson just over a year ago. These companies that were notorious for delivering a lot of cash flow to their investors due to something going on, the overall market just becomes so negative towards them that they're discounting so much future growth into the company. It's silly to expect the company to not at least perform slightly better than what the consensus is. If you can say that, okay, this dividend is, say, yielding 4 to 7%, it's really safe from just a financial standpoint. And the company isn't going to go away overnight. The company might not be growing, it's not going to be going gangbusters like it used to. But if so much negativity has been priced in, and you have a good yield, and the company, you got to keep in mind, is actively managed by people that their job is to make that stock price go up, and so much of it's being counted against them, I personally think that that's something I would like to take a bet on, to assume that management's going to get their act together. They're going to figure out something else to grow the business, or, at least make the business not slow down too much. Keep that dividend strong. And then I believe if you're able to select a couple of those really lucky individual companies over the long term, they're going to give you massive amounts of return. They obviously give you a lot of risk, because essentially what you're doing, if this is a company that is so well known by the overall market, you are essentially saying that all of Wall Street is wrong. And that is something that is very difficult to do, and it's something that, shouldn't be done often. So I definitely think that if you are going to, be invested in one of these, say, turnaround businesses, that is something. It will give you a ridiculous amount of money, and it will give you a ridiculous amount of cash flow into perpetuity if you are right. However, there is a lot of risk, and there is a reason why the company is selling off so drastically in that short period of time. So definitely keep that in mind. But I do believe that these types of deep discount dividend paying stocks can possibly outperform just about every other asset class in the long run if you're right when you buy into it. And again, I'm going to say, look at Warren Buffett when he bought Coca-Cola. Can you imagine buying Coca-Cola in the 80s and riding it out, reinvesting those dividends as they go, never missing a beat, reinvesting those dividends, and then your dividends get you dividends, and so on and so forth. And you just generate so much cash flow based off of that one investment that ended up being right. I think that those are the big winners that you want to look for in your investment career. All right, so now I've explained the, kind of the top level, superficial level of what do I look for in the companies when I start to approach them from an income standpoint. What kind of like filters from, say 500 companies in the S&P down to like say 100. What do I look for? I look for those type of situations. But now what's the, that's kind of the, opinion and holistic approach to it. But now what's the fundamental numbers that I look for when I invest in that? Well, completely starting everything off I'm going to go directly to my dividend discount. And now, so stepping aside, to step aside from the qualitative type of investment play, that holistic approach that is going to be different for every individual. Say if you go from 500 companies in the S&P to 100, my 100 aren't going to be the same 100 that yours are based off our perspective and our living situations. But the thing that's going to be kind of the same across the board is the fundamental approach. And now the fundamental approach is something that, you essentially show me the numbers. You show me what the company's doing. You show me how much cash flow the company's producing and what you can expect in the long term from a company like this. And so to start things off, when I take a fundamental approach, I'm going to go right to my discounted cash flow model. So using Starbucks as an example of this. So you can see here with Starbucks, and I've gone over this model many a times, and it's, this model only kind of reassured me to buy more of Starbucks back when it was very cheap. And I'm pretty happy I had this model that was introduced to this type of investment because it gave me a lot more of a concrete way to analyze the company rather than doing the extremely, risky, say earnings discounted cash flow, or, say the dividend discount model. Both of those models are, they have a lot of issues with them. They had a lot of flaws. Not to say that this model doesn't. Every financial model does there. You'll find even in the, say the industry players, all of the models have some flaws with them. This particular model, though, just happens to have a lot less flaws, in my opinion, than the other ones. You take a look at it and you have Starbucks. And now Starbucks, I am able to, kind of dump all of their financial statements onto this and really get a better feeling for how the company's being run and what type of returns the company's been generating over the past few years. So I'm able to see, okay, how are sales doing? How is income doing? How is cash flow doing? How are dividends doing? Everything like that. How safe is this company in the short term? Then based off that and based off, starting off, the deeper dive into the broad market and look at the consumer trends, how strong is that cult? And then, what are the other trends going on in the stock market that either support or negate this type of growth continuing? And then you make some estimates. You make some short-term estimates, you make some long-term estimates, and then you're going to discount back all of that cash flow and all of the assumptions you've made, and you're going to get these stock prices. And, based off those stock prices, so this is currently, I just kind of tweaked this today, actually, for Starbucks, based off of what the company revised it, and, the stock price kind of sold off about 10% from its recent high. And in my opinion, if it was trading at the level it was already, it shouldn't matter based off of these calculations, but we'll see in the future how that goes. But for right now, for example, you can kind of show that, if I just look at Starbucks currently right now, I think Starbucks is roughly fairly valued, especially because of the fact that, so this is taking into consideration their new revised guidance. This is going to be a quick little tangent, but then you also have to really pay attention to what you're discounting them on based off what the, federal funds rate is. So if that goes down, stocks naturally should appreciate more. So even if Starbucks' individual growth still goes down a slight bit, but then the overall benchmark that they're compared against in terms of what people are parking their money in also goes down, Starbucks is still more attractive of an investment, vice versa. And that's something you definitely need to keep in mind when you're looking at any company, especially a company that has a yield attached to it and is giving you cash flow. So that's something you definitely need to keep in mind. And so now, doing this, and you assume that, okay, I am either getting a roughly fairly valued, measurement for the company, or I think the company is at a discount right now. What do I do from there? Because again, as always, taking this type of approach, I think you should definitely expect to pay fair value most of the time for a company that's at this quality of a company. You're not looking for a small cap that could get a massive mispriced by the market. most analysts are covering all these companies, and most things people expect to come out of the company in the short term. So you're going to be looking at from the long term, and then how much of a discount can you get now for a long-term great company. And then so everything after that you can kind of run through is just kind of a really quick rundown of things that I would keep in mind to now put in a screener, now sift through say the 100 that you picked. You're going to want to look at the payout ratio. I personally, for any type of investment, I don't want more than 70% of its earnings going into a dividend. I think that too much. More than that, over the past 5 years. Now, obviously, 1 year or not can really tweak the payout ratio one way or the other. But over the past few years, how is the payout ratio? I like to see it capped at 70. Ideally, I would like it below 50, but capped at 70 is my hard limit. I want the dividend growth to be over 5% for the 5 prior years, because in all honesty, if the dividend's either stagnated or getting cut, odds are it's not going to be around for much longer. So I just want to maintain at least a solid amount of growth that I think is reasonable for most investments. I want a Z-score, which an Altman Z-score, I'm not sure if everybody knows about that. That essentially tells you the risk of bankruptcy that the company has, at least in the short term. And I want that over a 3. So that scale, if you guys are interested, I can do a whole video on that. That kind of assesses the company's performance based off of the amount of leverage it has, based off what's going on in the environment. And, you can kind of say, like, okay, if I park my money in here, what are the odds of it going bankrupt? So I think that's definitely something important. And then, from another top down, I want ROE, ROA, and ROI to all be above 10% for the past 5 prior years. Because essentially, these are the ratios that are going to make you money. It's not the PE ratio. It's not all the multiples out there. Like, these ratios are what makes you money, because that's what the actual company is producing based off the equity and the assets it's given. The company is able to make money to that degree. So these are definitely the things that really drive a company over the long term. And you want all those to be on the, the upper bound of normal, because if they're all just kind of going flat, odds are that company's going to be in for a rude awakening over the next 10 years. So I'd definitely keep that in mind. Then going into interest coverage ratio. Now, interest coverage ratio is something that you got to think about. A lot of companies, especially big companies that pay dividends, take on a lot of debt. And, the past 10 years, debt's been pretty damn cheap. So you can't really blame most companies for taking out a good chunk of debt now, because it's essentially impossible for them not to be able to pay it off, assuming they're executing well in their businesses. But regardless of that, I still want to have an interest coverage ratio of at least 5. This means that their earnings that they're bringing in are going to be able to cover off that interest 5 times over before they ever start to run into issues. This way, even if there's an economic recession or any issues going on right now, the company could lose half of their profits and still pay off their interests, no problem. And so that's something I just like having on the back of my head, knowing like, okay, worst comes to worst, this company's not going to go bankrupt. And then finally, just to top it all off, I want to look at the, the operating cash flow and the free cash flow over the past 5 years and make sure it's going in the positive direction. Now, depending on the age of this company and the market that the company is in, obviously, it can be going up, say 5% a year, 10% a year, whatever. But as long as it's going in the upward direction, that's all I really care about. Because again, I'm parking my money in here to generate me passive income for perpetuity, essentially. So if it's already getting shaky in the amount of money that's going to shareholders, I don't want to touch it. I don't want to have anything to do with it. So if that's not positive, at least for the past 5 years, going in the positive direction and growing more and more, I'm not even going to touch the company. So that's essentially, my quick checklist in terms of like, okay, I refined 500 to 100, go through this checklist. Now I'm left with, maybe 30 companies. And then from the 30 companies, I do my really deep dive. And my really deep dive is something, I think everybody's deep dive, can take months and months at a time. Like for Starbucks, for example, just because I already mentioned them, it took me 5-6 months of researching Starbucks before I was confident enough to put my money into it. And then thankfully, randomly one day it dropped 20% and I just pulled the trigger right then and there. Because I don't think I should ever, I try to take the approach that I want to know as much as I can about the company to begin with. And even if it's a little overpricey, I'll hold off on it. And the second the buying opportunity comes, I don't need to do any research. I just know I need to buy it right away before the deal gets taken away. So that's kind of my overall opinion. And so these are the things that I look for when I look for an investment to give me cash flow. There's obviously multiple ways you can do this, but these are the ways that I think have worked best for me, and they're the ways that I'm going to be continuing to do and cover here on the channel, and the ways that I expect to grow my overall wealth over the remainder of my life. So hopefully you guys got some use out of this. Let me know in the comment section down below if there's anything in my quick analysis that I didn't go over that you guys include in yours. I would love to hear a different type of approach that you guys do, and let me know if there's anything that I went over in this video that made absolutely no sense to you, because I will try to explain that in the comment section down below. You guys know I'm pretty good about getting back to everybody down there, so feel free to leave a comment. And so I know this was a long video, guys, but thank you guys for sticking with me, and I will catch you guys in the next video. Peace.